What's up you guys, Charles here and welcome back to the channel. So, as you probably know, the world has been locked down. This is an unprecedented time and has caused the stock market, among other things, to completely crash and loads of people to lose their jobs. Now, coronavirus has caused the stock market to crash by almost 33%. But the Fed in America went and bailed out the US stock market amongst loads of other companies. But the Fed's stimulus has boosted the market back up and is currently almost back to where it was. But the thing is that a lot of experts are predicting that it will crash again. So in today's video, we're going to go over 10 reasons why it might crash again. Now, as you and I know, there isn't currently a vaccine to the coronavirus. So what would this mean? This means that since no one is immune, apart from if they've caught the disease, there can be a second wave, and this has been predicted by loads of doctors and experts around the world that they're expecting likelihood of a second wave. Now, this might be during the holiday summertime, and they say this is more likely, is towards the end of the year when it's winter and people are inside more and the disease is able to spread faster. And with the reopening of businesses around the world, this means that more people are going to be out and there'll be a higher transmission rate. Now, the stock market reacts badly to these outbreaks because this means that it might cause another lockdown. And another lockdown would be businesses would have to close and jobs would be lost even more than they were before, especially as furlough is not 100% guaranteed for a second lockdown. This of course would mean less business and in turn cause the stock markets to crash again. Now, the second thing is stimulus packages offered by the government. For example, in the US, the $2 trillion stimulus package are only temporary. Because you see, although every American got a check of I think it was $1,200, and in the UK 80% of the wages were paid under the furlough scheme, this is just a temporary band-aid by the government that's been put on the stock market and other things. You see, although this stimulus check is currently keeping business afloat and people's jobs, after this some businesses will struggle to pay back their loans and mortgages, and as the unemployment rate gets higher and the people that have been laid off from their jobs, well, the current stimulus allows them to keep on spending some things, which contributes to the economy, which then causes the stock market to rise. However, when they run out of this stimulus, they're going to have to cut down on money, tighten their belts, and this means they'll be spending less, which will result in less of an economic growth and perhaps a bear market and a crash. Now, the third thing is although the government has given a stimulus to a lot of businesses, some of these small businesses are still finding it extremely hard to keep afloat because they just have no business coming in at all, no customers. This means that although they're allowed to furlough their employees, a lot of them are forced to cut down their employee numbers. And not only that, some of them even have to just close down altogether. And the closing down of small businesses will result in a rise and maintenance of high levels of unemployment, and this means people will be able to spend less again and will result in a decline in the economy. Now, a fourth thing to consider is unemployment will last longer than the crisis itself will last, because it will take a few months to be optimistic before new businesses will be able to take place of the old businesses that collapsed during the crisis. On top of that, if you look at the unemployment rates in the US and many other countries over the world, they're one of the highest they've ever been, and it's currently not looking like they're going to recover anytime soon. Now, a fifth thing you might want to consider is mortgage defaults. Now, the mortgage defaults is, like I spoke briefly about before, is that currently banks are allowing individuals and a bunch of people to not pay their rent and not pay their mortgages and give a late payment on their mortgages without affecting their credit score or other things. But the fact is they can't do this forever because they need that money. And when they start asking for the mortgages and people are unemployed or can't pay their mortgages, they're going to default on that, and that will sooner or later hit the economy. Now, another less talked about thing is that the earnings per share, so this is something that a lot of stock pickers and individual investors look at to calculate the value of a company, aren't accurate at all. There's been a study showing that 50% of all stocks are taking into account the impact of the coronavirus on their earnings per share. This means that 50% of them aren't, meaning that a lot of individual investors, although they think they're getting a good bargain on it, are actually losing out because the earnings per share value is wrong. This means that a lot of stocks will be inflated in price, resulting in stock markets being inflating in price until people realize that actually it is inflated in the price that it is selling at, and they'll start selling quickly, and this will make the stock market go poof, And yes, of course there's more. There's also reduction in stocks buybacks. A lot of people might not know what a stock buyback is, but essentially a company will buy back some of its shares so that there are less shares available on the market, increasing the shares on the market in value because supply and demand. Since there's less supply and there's the same amount of demand, the value of the stock will increase, and that's a large part, whether ethical or not, of corporate stock gains. However, during the coronavirus, they've been able to buy back less of these stocks because they don't have the money to do so, and this means that it will cause the shares to go back down. Now, another aspect is there's just a looming recession. Most experts say that things will have to get worse before they are able to get better. There's been almost 14 years of a bull market in the US and everywhere in the world, and people often forget that there are bear markets. Although they appear less often, they do exist, and people have forgotten what happened in 2008. They're not used to a sort of bear market where it's hard to make money. And the fact is that it's very unlikely that the Feds will be able to bail out Wall Street again. And same in the UK and everywhere else in the world where they've been giving stimulus checks out. You see, this recession and crash and market correction and everything has been forecasted to happen for years and years now, and people have been saying, oh, this year is going to be the one that it crashes, this is going to be the one that it crashes, and it happened to be during the coronavirus, except now it's bounced back, which is very bizarre, although it's mainly driven by the fact that the Federal Reserve has printed a huge amount of money, boosted it into the economy. Now, another qualitative factor that is often overlooked is fear and uncertainty. Listen, a lot of the stock market is driven by fear and uncertainty. And a lot of people's losses are driven by fear. They sell when things start to go badly, and they buy when things are starting to go well. And this means they buy high, sell low, and they often lose money. And during these times, everyone is fearful. Although it's getting better now, people are still fearful, and no one knows what the future looks like. As long as there's no vaccine, a lot of the over 70s and consumers over 70 are still going to have to be locked up in their homes, in care homes and all other things. This means they're going to be able to contribute less to our economy. And uncertainty leads to inaction, and this means that people won't take action and be fearful of the stock market price and won't know whether they're supposed to invest or not. And the inaction will cause the stock market to slowly decline, a bear market. And last but not least, there's been huge amounts of misinformation in this crisis, as is just in the news in general. As you can see from various topics, they show only parts of clips or give misinformation or just downright wrong information. This causes a lot of people to be fearful and to make wrong decisions. And if you have lots of people making wrong decisions in the stock market, it will either cause a bubble or a wrong crash where you can buy at a discounted price. But usually it's a bubble where people get hurt, and this could be it. Now, another thing is that Warren Buffett has recently taken a lot of money out of banks. This means that he remembers what happened in 2008 where banks had to be bailed out by government, and he's taking it all out to have it in cash. And why would he have it all in cash? Well, that's because that means that when the stock market goes terribly wrong, he's going to be able to buy a huge amount at a low price, and just the economics, you buy low, you sell high. So if you watch what a successful person does, and you're able to imitate it. So if Warren Buffett is keeping a huge amount of cash, there's really only one reason he'd do that, and it's probably because he's expecting a crash to arrive. Oh yeah, and another reason the stock market might crash is if you don't smash that like button, because it really helps me and the channel reach more people, to inform more people about personal finance, investing, managing money, and in the future I want to go over videos of traveling and how you can budget for traveling also. So finally, if you have enjoyed this video and have gained any value from it at all, I would really appreciate it if you did smash that like button. And this channel is all about helping under 30-year-olds manage, budget, invest, save, and all sorts of things related to money, because you weren't taught it at school, and hopefully being able to invest and manage their money correctly so they can spend money where it actually matters. So if that sounds like you or something you want to learn about, then remember to smash that subscribe button too. See you next time.